So, hi guys, in this video, we are going to be practicing two examples of deferred tax. And before we start, if you are not comfortable with the concept of deferred taxes, if you often get confused in this topic, I will recommend you to watch this video. It's a slightly long video, but it will really help improve your understanding of deferred taxes. Once you've watched this video, come back to this example. And if you are comfortable with deferred taxes, let's start. So in 2005, Company A received advance payment of $100,000 for services that it will perform in 2006, which means that in 2005, I received advance revenue. Advance revenue, you can also call it as unearned revenue. The reason this revenue is not earned right now is because you have not fulfilled your performance obligation towards this revenue. You have to perform some service. Once you have performed your service, then you can say that, okay, yes, this $100,000 is my revenue. But until you have performed your service, this is an unearned revenue. This is a liability for you. You have taken money from someone and you have not performed the service. It is a liability. You have to still perform the service for them in the next year. So this is going to be a liability. And it is basically of $100,000. Now let us see what will happen in your books of accounts and what will happen in your tax statement. And if you followed my videos, let's just see what will the taxman tell us and what will the businessman tell us. So in the books of accounts, revenue cannot be recognized in 2005. You cannot do that. It is basic accounting principles. It cannot be recognized in 2005. You have to recognize it in 2006. So in 2005, revenue is not going to be recognized. But however, in the tax statement, the taxman will say that you have received this income. It has to be taxed. Okay, so the taxman will say that please calculate your income tax on this amount, and the businessman will say that listen, I'm not going to recognize it as my revenue only. Now, if I don't recognize it as my revenue, obviously it is not going to flow into my net income, goes without saying, right? So, what will happen? Your tax payable as per your income tax statement is going to be greater than your income tax expense. And when something like this happens, it results in the creation of a deferred tax asset. So, first of all, we understand that, okay, it is not a deferred tax liability, it is a deferred tax asset. That thing we've understood because revenue is being taxed in advance. I have already paid the tax as per the income tax statement, but I have still not recognized this revenue in my books of accounts. When I recognize this revenue in my books of accounts, I will not have to pay tax on it because I already paid tax for it in the previous year. Right? So this is going to be a asset for me. It will save taxes in the future. My income tax expense as per the books of accounts is less than the tax payable as per the tax statement. It is going to save money for me in the future. It is going to save taxes for me in the future. If anything is saving money for me in the future, it is going to be an asset. So this right here is a deferred tax asset. The question is of what amount? Now here obviously it's very simple. In this example, it's simple. I will complicate the example in the next slide where we talk about change in the tax rate. We'll discuss that also, but first understand the basic construct of the question. So here, what is the difference between your tax base and your carrying value as per books of accounts? So in your tax statement, you have already paid tax on this entire amount. Whereas in your books of accounts, you have not recognized this revenue only. So you will be creating a DTA on the difference, which in this case is of 100,000 multiplied by the tax rate. Now, very important, what should be the tax rate? This tax rate has to be the tax rate at which the reversal is expected. So, for example, in our question, this service will be performed in 2006. So in 2006, I will recognize this revenue in my books of accounts. Right now, in my books of accounts, this is unearned revenue, it is a liability. In 2006, when I perform the services that I need to perform, I will recognize this as revenue. In 2006, it will come into my income statement. It will start contributing to my income tax expense in 2006. That is when the reversal will happen. That is when the savings of tax will happen. So this rate always has to be the future tax rate, the tax rate of the year in which the reversal is expected. So here they are saying the statutory tax rate is going to be 30% in 2006. So I'm going to use 30%. Very important, this rate is going to be the rate at which reversal is expected. So in future, whatever is the tax rate at which the reversal is expected, that has to be the rate. So in this case, I will end up creating a DTA of 30,000. And this I will create in 2005 only. Obviously, right? Because the reversal will happen in 2006. And for that reversal only, I am creating a DTA in 2005, which is of $30,000. Okay, so I hope you understood this part. Now let us discuss the actual example which I had sent in our community, because of which a lot of you got confused. Let us discuss this example. So in this example, everything else is same, just there is a tax rate implication also. So here we are saying that the statutory tax rate changed from 25% to 30% in 2006, which means that in 2005, the tax rate was 25%. And when we actually come to 2006, the tax rate becomes 30%. So we did not know that this change in tax rate is going to happen. When 2006 actually started, we realized that, okay, the tax rates have changed from 25% to 30%. Now, please understand what is happening. You have already paid tax on $100,000. The tax authorities cannot tell you that pay me more tax now. You're understanding? On $100,000, on this amount, I have already paid tax in 2005. In 2005, I have already paid tax on this amount. The tax authorities cannot come and tell you in 2006 that, listen, the tax rate increased, please pay me more tax now. It does not happen like this. The rate changes are prospective. Normally also they are prospective. Whenever, rates keep on changing. For example, let's talk about your salary. If the rate changes the next year, do you think the government will come and tell you, listen, whatever salary you received in the previous year, please pay more tax on it now? It does not happen like that, right? So whatever tax had to be paid, that tax is already paid in 2005. You don't have any obligation towards paying more taxes on this $100,000. That tax is already paid. So in 2005, I must have created a deferred tax asset. How much deferred tax asset I must have created? Ideally, I should have created a deferred tax asset of 30% of 100,000. Ideally, I should have created this, but in 2005, I did not know that the tax rates will change in 2006. If I had known in 2005 itself that next year the tax rate is going to change, it is going to become 30%, which was what was happening in this example. In this example, I already knew in 2005 that the tax rate is going to be 30% in 2006. So I used that rate directly. But most of the times in practical life, we don't know exactly what is the tax rate going to be in the next year. So in 2005, I should have created a deferred tax asset of 30%, which means I should have created a deferred tax asset of 30,000. Why 30,000? Because you have to always use the tax rate which will prevail in the year when the reversal happens. Okay, because I will recognize this $100,000 as revenue in 2006. In 2006, it will come into my income statement. In 2006, the reversal will happen. So whatever income tax expense is there of 2006, there it will save my money. So in 2006, if I am going to calculate taxes at the rate of 30%, it is going to save me money at the rate of 30%. So always remember, we always use the tax rate of the year in which the reversal is expected. Right, the reversal will happen in future. Most of the times we don't know this rate. How will I know what is the future tax rate 5 years from now? I won't know. So I use the existing tax rate as the best estimate of the future tax rate. You're understanding? Because in 2005, there is no way for me to know that in 2006, the tax rate will change to 30%. Unless the government comes out with a notification that next year, we will change the tax rate to 30%. I don't have any way of knowing that the government will do this. So in 2005, using whatever best available data I had with me, I created a deferred tax asset at the rate of 25%, which means that I created a DTA of 25,000. See, please understand, this is not wrong. In 2005, I did not know that the tax rate in 2006 is going to be 30%. So I used the existing tax rate. I created a deferred tax asset of 25,000. Everything is fine. Then 2006 actually comes, and I come to know that, okay, the tax rate is now 30%. Okay, which is what I come to know in 2006. In 2006, I come to know that the tax rate is 30%. So I think about it and I realize that my DTA balance for this revenue item, it should be whatever is the difference. In our case, the difference is 100,000 into 30%. Because the reversal will happen in 2006, and in 2006 the tax rate is 30%. So I realized that the DTA balance should be $30,000. What is the existing DTA balance? The existing DTA balance is 25,000. The DTA balance should be 30,000. I have a balance of 25,000, which basically means that my DTA balance needs to increase by $5,000. And that is your final answer. DTA should increase by 5%. Basically, it should increase by $5,000. This was the question. See, in this question, if you don't understand what is deferred taxes, it's going to be very, very problematic. You need to understand the whole concept of deferred taxes, how a deferred tax asset gets created, how a deferred tax liability gets created, what is the thought process behind it. If you are not clear on that thought process, you won't be able to solve questions on DTA, DTL. Even if they bring a slight complication in the question, you will get confused and you won't know what to do. Which is why I uploaded that video. Check it out, check from whatever source you want, but have a very strong understanding of the logic behind DTA, DTL. Okay, always, whenever you are creating DTA, DTL, this tax rate is always going to be the tax rate of the year in which the reversal is expected. But what is the practical problem? For example, let's say this reversal is expected 2 years from now, which means that I received advance payment and I am going to provide some service 2 years from now. Now, how will I know today what is the tax rate going to be 2 years from now? I will not know. So I obviously have to create a deferred tax asset, and I do that at today's tax rate because I don't know what is the tax rate going to be 2 years from now. Then, as time passes and I come to know what is the actual tax rate going to be in that year, I obviously will have to update my balances. Okay. DTA, DTL always created at the rate which is expected to prevail in the year when the reversal is expected. Practically speaking, we don't know what is that rate going to be. Practically speaking, we don't really know very strongly when the reversal will also happen. That is why we simply use whatever is the tax rate at this point of time, because we don't have that much of data in real life. Okay, but as you come to know of this data, obviously you'll have to adjust your DTA, DTL balances, which is exactly what this question was about. I hope you understood this and keep studying. If you have any more questions, drop them down in the comments below. I will try to get back to you.